Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And on today's episode, we are going back to answering fans' questions number 3. But before we do so, I got to give you that free tip of the week, which is before you look into term life insurance, check with your company to see if they have an insurance policy that you can use through the company, as it will be infinitely cheaper. So a lot of people, I could argue almost everyone needs some form of life insurance. So I'm not going to debate that. But a lot of people assume, I just need to go and buy term insurance for myself, which is fine. There's nothing wrong with that. But a lot of people totally space, and it's understandable because a lot of people don't do a great job of publicizing this, but a lot of people completely miss the boat on going to your company to utilize a term life insurance through the company. Now, there's pros and cons with that. If you plan on being with that company for a very long time, the term life insurance route through the company policy, it's going to be much better than getting it individually from a cost perspective. However, if you think that within the next couple of years, you may decide to jump ship and go to another company. If you already know that that company has term life insurance, that's fine, because then you could just hop onto theirs when you go. However, you never want to bank on something you're not quite sure about. So generally speaking, all things being equal, in term life insurance will be infinitely cheaper through a business. And that's where you first should go. However, it is worth looking into if you're going to be jumping ship in a couple of years. So now that we got that out of the way, we're going to be answering your questions that you've sent me. And one of you in this episode, because we're going to be answering 3 questions, one of you asked, you got lucky because I'm feeling very giving, and I'm going to answer 2 questions that someone asked me. So you're getting a twofer. But the first person that we're going to go over is Kit Lamb. So Kit Lamb asked, when do you cash out of the market for a down payment, especially in the election year now? So this was actually asked a couple months ago, but we were finally clawing out of answering all of your questions. But the first part, it's kind of a universal thing. So let's go over the first part. So when to cash out of the market for a down payment. And by market, I'm assuming you mean stock market. Don't overthink it. So if you see the right home and you think, hey, I'm going to own this thing for at least a decade, or in many cases, it could even be your forever home. And you look at your portfolio and it's grown to that dollar amount in which you want to put that down payment down, which I'd recommend 20 to 25% of the purchase price. You got to liquidate your portfolio and you got to make the move. And you really can't think anything else about it. Now, if you are saving money in an online savings account and or something that you don't have to think about, like market timing, which frankly, there really isn't such thing as market timing. I think that's a huge misnomer. But not getting off track here. If you're saving money in an online savings account or something that doesn't need to be liquidated, it's really that simple. You get to that dollar amount, and once you've saved it, you go searching, you snag the house, and you go from there. Now, one thing that you got to be aware of, and we've seen this in the past, where people, they've saved up for that down payment on their forever home or their dream home, they liquidate their portfolio, they put the down payment on down, and they're rocking and rolling, and then comes the new year, like right now, and we're in the thick of tax season, and you go, oh my gosh, I forgot I owe taxes on all of those gains. So you've really got to be aware of that. And if you liquidate your portfolio at, let's say, the beginning of the year, well, you have a year and a half until tax season for in this case, this year, the following year, to actually pay those taxes. But if you liquidated in, let's just say, November or December of the year before, you've got to remind yourself that, okay, you liquidated your portfolio, you've got this down payment ready for this home, but you've also got to account for the taxes that you weren't prepping, because even though you're withholding money from your wage or salary or however you get paid, you can control all of that, but your wage and in salary and in paycheck, that has no understanding of how the rest of your portfolio is doing, if it's a taxable account. So just be aware of that. Now, if you really want to nitpick it, you could wait till your portfolio is slightly higher than the down payment that you need, because then once you know that, you can kind of do the mental accounting in your head going, okay, let's say I'm making numbers up. Let's say I needed $100,000 for a down payment to save up, but I liquidated my $120,000 portfolio. All right, there will probably be some taxes owed from that, but I'm still good on the down payment side of things. You can do that, but you've also got to be aware that sometimes when you're thinking short term with long-term investments, you're kind of playing Russian roulette. So you just got to be cognizant of that. Now, when it comes to any type of an election year, when it comes to a down payment, or really just anything in general in the world of money and investing, you have to completely block out the noise. If you're buying a home, just going back to your original question, Kim, you shouldn't be thinking about flipping this in 2 to 3 years. I know that's a really popular thing on social media, is you buy a house and you flip it in 2 to 3 years, or 2 or 3 years might even be too long, maybe 2 to 3 months, and get that quick rate of return and everyone goes home happy. That is so not how reality works. And on top of that, one other thing I wanted to mention from an electoral position regardless if it's presidential, Senate, House, governor, it really doesn't matter. Regardless of who is in power, and in the United States, it's White House, but globally, whatever house is top of your country, regardless of whoever is in that position, it will not affect the long-term status of your plan or home value if you're thinking 10 plus years. And this also goes for your entire financial situation. So, and we've talked about this in the past. In fact, I believe it was just recently. You can't completely eliminate risks from your portfolio, meaning you're going to have some type of business risk to certain degrees when you are investing. However, there are some risks that you can control more so than others. So if you have political risk in your portfolio, and it's extremely high, because again, you can't completely eliminate it, but if you have extremely high political risk, you need to take a serious look into owning other investments, and you got to make life easier on yourself. And actually, you don't even have to take my word for it. You can take all of the best famous investors in the world. And there's a couple examples before we move on to the next question. So one of Warren Buffett's famed investments, and there are a couple of his big ones, Coca-Cola, not a lot of political risk there. See's Candy, not a lot of political risk there. Gillette, not a lot of political risk there. Apple, you could argue now because it's become a global brand and all that, but really there's not a ton there. You look at Peter Lynch back in the day. He was famous for investing in, a number of things, but Toys R Us, back when Toys R Us was not bankrupt and it was actually a successful brand. He invested in WD-40. He invested in waste management. You look at a company like Wrigley's Chewing Gum. I've mentioned that in the past. I'm not a famous investor like those guys by any means, but that's one of my favorite investments of all time. And this is not investment advice. This is getting you to understand that it is significantly easier to earn a superior rate of return than you may think because of all of this noise. And going back to the political risk side of things, that is the easiest risk that you can completely mitigate. So Kim, great question. Really 2 questions. Cheater. I'm kidding. David Duranko. This is question number 1 because you asked 2 questions because you're greedy. I'm kidding. Kind of. Now, your first question is a question that was stemmed from my first book, which, as a side note, I always love digging deeper into. And so really either book. But if you guys ever have questions on my book or books, please hit us up with those questions, and those would be great for the show. So David's first question, and then we'll take a quick commercial break. Regarding fixed costs versus variable costs versus gap money, what if it feels like my fixed costs are greater than my income? Do you have a strategy to tackle this issue? Note that writing feels, quote unquote, has been a deliberate choice. Man. And it's a great question. So there's multiple ways to answer this. The first thing that you got to think about, and you actually mentioned, so what if it feels like my fixed costs are greater than my income? So I'm not trying to plug my profession here, but that is where a quality financial planner can dig in and kind of tell you black and white what in the world is going on. So even though it may feel like it, numbers are numbers. And David, I know you know this more than most people, but regardless of who you are, the numbers are going to tell you everything. Now, I know we just got done with Christmas and New Year's. And so because of that, many of you are probably digging out of the financial hole that you dug yourselves into because you love other people and you wanted to spread the Christmas cheer. But that's beside the point. It's one of those things where in normal times, so not during a holiday season or that time of year where all of your family members have a birthday at the exact same time, which is always unfortunate. It's one of those things where you look at the normalcy and you go, okay, let me remove my emotion. Let me actually write the numbers out. That's why in my book, I was so big on the starting with the budgeting and the expenses side of things and capitalizing on your expenses. Because once you understand what is fixed, what is variable, you write all those down, and then you write those numbers out, and then you write what's net hitting your checking account every month. There is no way for you to have that feeling of, oh, I'm actually falling behind. Now, as far as strategies to tackle this issue, one of them I kind of just mentioned, which is the obvious. You write it all down, you look at it, and that will actually tell you what is really what's up. From an operational perspective, and this is another way to think about it, I actually got to give my buddy Nick Hutchison another shout out. When he came on our show, he talked about Parkinson's law. And it's the concept of if you have something at your fingertips, you're going to use it. So if you have a sweet tooth, you're going to eat sweet foods. If you have money at your fingertips, you're going to go and spend it. If you have popcorn at your fingertips, you're going to sit on your couch and watch a movie, things of that nature. So in order to avoid Parkinson's law, you automate those processes out. So when it comes to money, and in the States, because I know you're overseas, David, but in the States, you can set up automatic payments to a Roth IRA account or an individual retirement account or a taxable account. Or if you work for a company, you set up your 401k contributions. Let's say that you're doing all of that and you still have this weird feeling of, you have this weird feeling of your fixed costs being greater than your actual income. You can set up a systematic dollar amount going to your savings account every month. And it may not be anything crazy, maybe $100 a month, if that. But it gives you the confidence of, and it's a small win, but it's a win nonetheless, going, oh, I actually am saving my money every single month because I'm actively putting money aside, so I'm not outliving I'm not outspending what I'm making. And then one other strategy is if you actually look at your checking account and you look at the balance at the end of every month for like 3 to 4 months straight, if that number is growing, that just tells you from a behavioral finance perspective, as well as black and white, you're not overspending. If it's obviously decreasing, now we've got to go back to capitalizing on your expenses. But then even if it's kind of like bumping around and at the same dollar amount, that's not a bad thing, because that means that you're doing as much as you can to set money aside and save, but you're also living within your means, but you're not going backwards. That's a phenomenal thing. So once we come back from the commercial break, we're going to answer David's second question, which, spoiler alert, it is a winner and it's a doozy. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the show. We're going to get right into David Duranko's second question. So I know, David, you've been waiting eagerly for this answer. So this is a great one, and I wanted to save this one for last because it's going to be a little bit longer of an answer. So general and personal question. How would you approach financial planning as a 28-year-old husband and father that is currently starting a business? And are there any strategic steps you would take right now? Well, I will tell you, first off, starting a business after the fact of having kiddos, that takes guts. So my hat goes off to you, my good sir. How would I approach financial planning as a 28-year-old husband and father that's currently starting a business? So that first part, I would tell you, one, it's actually interesting. We just recorded an episode a couple episodes back on self-employment, and highly recommend you go and listen to that again. But I can tell you from a mentality standpoint, above all else, before you think about the investing side of things and planning and all that fun stuff, you have one goal in mind. And especially because you're married with kids, you have one goal in mind with your starting, with your newfound business. Forget all of the minutia of investment jargon and planning jargon. Go make money and make as much money as fast as possible. Now, obviously not at the expense of other people, but that's what you need to do. And if you are starting this business, whatever it may be, you've got to get used to long nights, long days. You're going to be missing some things with your wife and kids. And that's just the name of the game. Now, in the long run, you'll be a heck of a lot better off for it, but you've got to fall in love with that, and you've got to make it a mental game. I also wouldn't recommend you get into, because I made this mistake early on. I read all of these articles about tips and tricks of how to be successful and how to run a successful business and get it up and running as fast as humanly possible. That was all a waste of my time. Now, Obviously, there's a reason why I wrote my second book, which teaches people how to sell. But even with that, once you read it, you want to use it as a guide, but you need to get out there. You need to talk to everyone. Your goal in the first year is to simply become as known as humanly possible in what you are doing within your business. And I don't care what it is. You just need to become known. Second year, you'll become trusted, and referrals will start to come in year 3 and for sure year 4. But you need to become known. As far as strategic steps, now I don't know the business that you're starting. I also, because I believe you're in Germany, I do not know the tax code over there. I should probably brush up on that. But it's one of those things where even regardless of intricacies of different countries and currencies and all that fun stuff, you need to make sure that you have a little bit more cash on hand than you think. If you think you need about 9 months worth of emergency fund, you probably need a year or a year and a half. If you think that you are going to become profitable in, let's say, 6 months, it's probably going to be a year and a half, maybe 2. Now, to speed that up, you need to build your network of successful people and successful businesses that will support what you're doing. So, for example, let's say that you're going to start a roofing company. You should be meeting every architect in town, every builder in town, every HVAC company in town, every electrician, every plumber. All of those players help you build the home, which is obviously topped off by the roof. You should be going to networking events on a regular basis and getting your name out there. You should have your business set up, your business setting accounts, your checking account. You should have your EIN number or whatever they call it in Germany or wherever you are. You should have your tax professional. Your in the States, we call them a CPA or an enrolled agent at your fingertips, because life's going to get a little bit more complex for you when you run a business. As far as like the best strategic steps, though, I cannot stress enough. You just need to get out there and you need to get after it, and you need to fall in love with it, and you need to have the mentality of a hunter. And and frankly, you've got a family, so you can't afford to screw this up. You've got to go and work to the point where you know that not only are you going to win, but you've got to have the mentality of, I can't afford to lose. I can't afford to lose. And I know a lot of people think it's kind of crazy that I have this type of mentality when it comes to business, but early on, that's what it takes. And frankly, it's okay if you have that mentality forever, because that's what successful business owners have. But I would say if I could dwindle it down to one major strategic step that you need to take, is fill your calendar as much as humanly possible, as fast as humanly possible, and keep things as simple for as long as you can. So I hope that that answers your questions. And Kim, I wanted to say thank you also for sending in your question. These are a lot of fun. I have an absolute blast in answering these. And in a lot of ways, it actually takes me back to when I was starting my practice, or I started getting into investing or planning or sales or whatever. And it's fun going back to those moments, because unfortunately, as you keep progressing in your life, you forget about some of the most exciting experiences in business or sales or just your life in general. And when you guys send in these questions, it brings back some nostalgia to me. So I appreciate you and I thank you for that. So that does it for today's episode. As always, I'm your host, Christopher A. Paniotu, the Captain Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS confirmed by College for Financial Planning. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.